It's likely you've heard the terms bear market and bull market. They are used to refer to the activity happening in the stock market. These can be confusing terms, making them difficult to differentiate. Investors do not need additional confusion, so it is important for them to understand these terms correctly. Watching this video, you will find out what is a bear market, what is a bull market, what are the differences between them, and what are the phases of each type of market. So let's explore the meanings behind these two zoological metaphors and what they really mean for investors. Why is it called a bull or bear market? The debate about the true origin is still ongoing. Many people think the terms bear, down markets, and bull, up markets, originated in how those animals attack their opponents. Bears attack through swiping down, while bulls are known to thrust their horns up into the air. These patterns of behavior were then related to the fluctuations of the market. The trend indicates whether the market is going up or down in general. If the trend is up, it usually means there's a good chance of high yields and a bull market. If the trend is down, it usually means there's high risk and the chances for bad yields are high, leading to a bear market. What is a bull market? A bull market is the condition that exists when prices are rising or are expected to rise. The term bull market is most often used in reference to the stock market, but it can also be applied to any type of tradable good, such as bonds, real estate, and more. The term bull market is used to refer to a long period of time where the majority of stocks are going up in value. Unlike bear markets, bull markets can last for a few months or even years. A bull market usually results when the rise in an asset or security price is an upward swing after a downward trend. Under the accepted definition of a bull market, stocks must appreciate by 20% after two declines of at least 20%. Investors leverage a variety of strategies, such as increased buy and hold or retracement, in order to gain profit in bull markets. What is a bear market? Stock prices are typically a reflection of future expectations of cash flows and profits from a company. When growth prospects dwindle and expectations are dashed, stock prices can decline. Fear-driven herd behavior and a rush to protect downside losses, which often lead to panic attacks, may set in. One definition of a bear market is when stock markets, on average, fall at least 20% from their peak to the bottom. However, there's no particular reason that a bear market should necessarily have to happen when the stocks fall by 20%. It could also be 10% or some other arbitrary benchmark. Bear markets can be temporary, lasting a few weeks or months, or they can be long-term. The latter last for years or even decades. Short selling, put options, and inverse ETFs are some of the ways in which many investors make up money lost due to bull markets. They're called bearish cycles because everybody is losing money by buying right when the market's high, just before it crashes again. Bull market phases. There are three main phases that a bull market goes through, which can be broken down into. 1. The accumulation phase. It usually comes at the end of a bear trend. Everything seems bad, but most of the bad news are priced in at this point. Investors who are informed start investing again during these periods. 2. The public participation phase. In this period, negative sentiment starts to fade as business conditions improve and economic data becomes stronger. With more good news and more people jumping in, prices go up. 3. The excess phase. The market becomes hot again and a lot of informed investors scale back their positions, selling to new investors. Smart investors look for signs of a weakening trend. If upward swings start to taper off, it could be a sign of an approaching primary downtrend, the onset of the next bear market. Bear market phases. Bear markets usually consist of 4 phases. 1. Phase 1 is characterized by high prices and high investor sentiment. Towards the end of this phase, investors start taking their profits and drop out of the markets. 2. At this point, stock prices start to fall sharply and the economic indicators that may have once been positive start to deteriorate. Investors who hadn't panicked in the first phase may now be doubting their stocks and sell them for a low price. 3. The third phase sees speculative investors hop on the bandwagon and inflate prices. Trading volume, in turn, increases. 4. In the fourth and last phase, stock prices continue to drop, but slowly. You'll know it's coming to an end when prices start to rise again, because good news usually starts attracting investors and trends start to turn around. Conclusion: bull versus bear markets. Opposite of a bull market is a bear market, with falling prices and typically a negative sentiment associated with it. The commonly held belief about the origin of these words suggests that the use of bull and bear describe how those animals attack their opponents, bulls being aggressive, bears being defensive-minded. When an economy enters a bull market, it means that its stocks are experiencing an upturn. As stocks tend to be impacted by the mood of current and future investors, they can often start experiencing increases even before other indicators like gross domestic product, GDP, which are more sensitive to economic changes. Likewise, in the event of a bear market, economic contraction usually sets in after it. A look back at a typical U.S. recession will show that the stock market falls months before the GDP declines. This is an important concept for any type of investor. A bull market signals rising stock prices and a strong economy, while a bear market signals falling stock prices and possible weakness in the world economy. When the market is doing well, it's hard not to feel like investing is a great idea, but don't forget that staying the course is often the best you can do with your money when a bear market occurs. I hope that this information has helped you understand these two terms better. Thank you for watching, and don't forget to subscribe if you haven't already. See you in the next video.